How banks actually work, a deep dive into modern finance. In this video, we're going to break down how banks work, from their early history to the current systems in place. We'll also explain how we, as a company, are doing well despite the ongoing SVB crisis, as we're bootstrapped and not reliant on investor money. Stick with us until the end, as we'll provide a comprehensive understanding of banking and how it impacts the financial system today. Footnote: understanding how banks operate is crucial to navigating the modern financial world. 1. A brief history of banking. Banking dates back to ancient Mesopotamia around 2000 BCE, where merchants provided grain loans to farmers and traders. Over time, banks evolved, offering deposit-taking, lending, and currency exchange services. The rise of banking in ancient Rome, medieval Europe, and the Renaissance marked the beginnings of modern banking, with key milestones including the establishment of central banks and the introduction of paper money in the 1600s. Footnote: banking has existed for thousands of years, evolving from simple grain loans to complex financial systems. 2. The gold standard, historical basis for modern banking. The gold standard tied a country's currency to a specific amount of gold, ensuring currency stability and facilitating international trade. While this system worked well for a time, it became too inflexible during economic crises, such as the Great Depression. The U.S. abandoned the gold standard in 1971, transitioning to the modern fractional reserve banking system. Footnote: the gold standard provided stability but was too rigid during economic downturns. 3. Fractional reserve banking, modern banking explained. Fractional reserve banking allows banks to hold only a fraction of customer deposits as reserves, loaning out the rest to generate profits. This system stimulates economic growth by increasing the money supply and making credit available. However, it can lead to inflation and bank runs when too many depositors demand their funds at once. Footnote: fractional reserve banking creates credit and stimulates economic growth but can also introduce risks like inflation. 4. Types of banks and services. There are several types of banks that cater to different needs. Retail banks serve individuals and small businesses, offering services like savings accounts, loans, and credit cards. Commercial banks focus on providing financial services to businesses, such as business loans and trade finance. Investment banks handle mergers, acquisitions, and capital market activities. Finally, central banks regulate the money supply and maintain financial stability. Footnote: banks provide various services, from personal savings accounts to business loans and investment opportunities. 5. Retail banks, the backbone of personal finance. Retail banks focus on individual consumers, offering checking and savings accounts, loans, and payment services. They lend out money deposited by customers, earning a profit by charging higher interest rates on loans than what they pay to depositors. This keeps the financial system running smoothly, facilitating everyday transactions. Footnote: retail banks support personal finances by connecting depositors and borrowers. 6. Commercial banks, supporting business growth. Commercial banks provide businesses with loans and credit to fund operations, expansions, and investments. They also offer cash management services, trade finance, and foreign exchange, helping businesses manage risks and optimize their cash flow. These banks are essential for economic development and international trade. Footnote: commercial banks support businesses by offering financing, risk management, and other financial services. 7. Investment banks, facilitating big deals. Investment banks specialize in capital markets and advisory services, helping companies raise capital, manage investments, and navigate mergers and acquisitions. They also act as intermediaries between investors and issuers, ensuring efficient market functioning. These banks play a crucial role in global finance. Footnote: investment banks help companies raise capital, manage assets, and execute large-scale transactions. 8. Central banks, ensuring economic stability. Central banks, like the Federal Reserve in the U.S., are responsible for overseeing the monetary system, controlling inflation, and ensuring financial stability. They set interest rates, manage the money supply, and act as lenders of last resort during financial crises. Central banks are critical to maintaining the health of a nation's economy. Footnote: central banks regulate the financial system to ensure stability and prevent crises. 9. The future of banking, what's next? As technology continues to evolve, the future of banking is changing. The rise of digital banking, cryptocurrencies, and decentralized finance is reshaping the financial landscape. We may see more integration of AI, blockchain, and other technologies that offer faster, more secure, and transparent banking experiences. Footnote: technology is transforming banking, introducing new possibilities for digital and decentralized finance.